Most people look at the returns and stop there. I think that misses the whole point of investing. Because returns are just the output. What actually matters is what created the returns. So in this video, I want to break down how my portfolio evolved, what actually drove the returns, where I made mistakes, and how I think about the portfolio today. Right now, the portfolio is fairly concentrated, I would say. The top 5 positions are around 60% of it, and the current mix is roughly 60% growth, 25% value, and 12% speculative investments. So there is a clear structure behind the philosophy. For me, investing is not about trying to look smart every single month. It's about compounding over years and years. That's why I think capital allocation is the real skill. Not just picking a stock, but deciding where capital actually goes. How much goes to that sector or company? How long do you let it work for you? In my case, that usually means holding a concentrated portfolio. My top 5 positions today make up around 60% of my total capital. Which tells you I'd rather back a small number of ideas with a very real conviction than own 50 things I don't care about. And if you get risk management wrong, none of these investment decisions really matters. If I look at the portfolio over the last few years, it has gone through a few clear phases. Earlier on, it was much more aggressive and more growth heavy. Then came periods of volatility, mistakes, and of course learning as well. And today, my portfolio is much more structured than it used to be. Even over the last 12 months, you can see that process has resulted in pretty good numbers as well. On the slide here, the portfolio is up 40.75% over a 1-year period, while the S&P 500 is up around 27% here. On the longer history shown here, the 3-year figure is also 24.75% for a 3-year period, what is extremely positive in my view. The point is that the process has become more disciplined over time, and I aim to bring it to the future as well. When I break down what really drove my returns, it was not one genius call. It was a handful of things done reasonably well over a long period of time. Allocation decisions, growth, value, external, internal, letting winners run, avoiding big mistakes, and of course the last thing, controlling emotions. One thing markets teach you pretty fast is this. Markets can stay irrational longer than investors can stay solvent. So staying alive matters in this game. Staying rational matters. And not forcing trades matters as well, as you can see from next slide. Like in most concentrated portfolios, a few positions did most of the heavy lifting. In my last 3 years, on the winner side, positions like Pershing Square, Microsoft, Google, and Meta were major contributors. On this screenshot, for example, PSH, Pershing Square, had an average weight of around 40.55% and contribution to the total return of around 21.77%. Microsoft had an average rate of 7.68% and contribution was 15%. Google had average weight of 16.67% and the contribution to the return of 15.05%. Meta had a contribution around 13.57%, as you can see from the slide. That tells the usual story. A few big winners matter far more than dozens of average ideas. On the mistake side, there were also positions that hurt. DXYZ ETF for the whole SpaceX, had a negative impact of 10% on my portfolio. The fund was so far from an NAV that I shorted it, and shorting, there is endless loss what you can make. So the lesson here is simple. Winners make money, but mistakes shape discipline, as you can see from the DXYZ and also Bitcoin example here. Today I think about the portfolio in two engines. The first is value. These positions do not protect capital in the sense of being risk-free, but they can have limited downside with real upside potential as well if chosen well. Usually these businesses are cash generative, asset-heavy businesses trading at the very low multiples. Because of that asset-heavy nature, you also need to watch slightly different metrics as well. Not just growth metrics or a price-earnings ratio. The second is growth, of course. This is more my natural background. High-quality compounders where earnings can keep scaling for years. There, I care more about earnings growth, valuation relative to growth, and whether the businesses have a durable moat. So one side of the equation, there is asset category where there's limited downside but real upside potential. But on the other hand, there is growth side where you can compound harder over time. And if I look at the current portfolio mix, it reflects that pretty clearly. Growth is about 62.6%. Value is about 25.4%. So yes, this leans on the growth side, which is my background, but with a more serious value sleeve than before as well. If you look at the actual portfolio today, and I think many viewers always like to see it, it is still fairly concentrated. The biggest position, as you can see, is Alphabet at 18.5%, then Meta at 12.8%, Amazon at 12.6%, Pershing Square, what is externally managed company, external asset manager, 9.3%, and then there's Jet2. Smaller positions like Bitcoin, 7.2%, Kraft Heinz, a value position, 4.4%, Warsaw Stock Exchange, and at 17.7%, one of the, I would say, newer positions is Jet2. Jet2 is trading at a very low multiple, EV/EBIT multiple, and there could be meaningful upside if the war ends and travel sentiment normalizes further. So again, this is not random diversification. Most of the capital sits in a handful of higher conviction positions, and I think that's the main takeaway here. At certain periods, part of the portfolio was also allocated to external managers as well. The important distinction is this. The capital allocated externally was only part of the portfolio, but the contribution to the total return since 2019 was around 43%. So depending on whether you look at capital weight or return contribution, the number can be very different. But all of this sat inside my own overall portfolio. That is why I have always looked at it as one portfolio. There are many different approaches inside my portfolio. There is direct investing, tactical positioning, and selective external allocations as well. And honestly, I still see myself as early. Making these videos is partly a hobby for me. I enjoy sharing how I think and making educational content around investing as well. But over time, I do want to move towards doing this more professionally and join forces with people who have maybe 15 or 20 years of real asset management experience. I think that combination actually fits well. My own background leans more naturally towards growth, and pairing that with experienced value investing and asset management people makes the overall approach pretty sound. So the next step for me is more structure, better process, and learning from people who have done this for much longer than I have done it. At the end of the day, this is what I'm trying to build. Not something that looks exciting for a month, but something that compounds over time. I think that is the whole game. Thank you so much for watching, subscribe, and see you in the next episode.